Happy Friday, everyone. It's 8 a.m. Chicago time, 9 a.m. Eastern on the 20th of January 2017. It is presidential inauguration day at noon today. Donald Trump gets sworn in as the 45th president of the U.S. I'm sure you heard about it. Going to be looking out for that and whatever comments are made. Um, Other than that, pretty regular day. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. The news overnight, some items um, are coming up. China's GDP came in at 6.8% year over year in the fourth quarter, ahead of the 6.7% that economists had anticipated. IBM's revenue falls, but Top's estimate IBM reported yesterday. It's still, I think, one of the biggest components of the Dow. They reported $5 and a penny versus 489 expected, 21.8 billion versus 21.6 billion expected in revenue. Other than that, I guess Jamie Dimon of J.P. Morgan got a raise and received $28 million last year. Just to give you an idea of what those guys do. And Yellen warns against running the economy hot. She is concerned. She says, I think that allowing the economy to run markedly or and persistently hot would be risky and unwise. I think that's a warning to the new administration. Um, as far as what we're looking for today, there isn't too much on deck here. There's actually nothing, just speakers. As far as releases, we don't have anything. We have Fed Speaker Harker currently talking. He's a voter and a hawk, speaking about economic outlook. Then we get the inauguration at noon, and then we get Fed Speaker Williams at 1 o'clock today. So it's not it's there isn't that much there on deck. Let's take a look at yesterday. There we go. So got an email yesterday saying, well, you talked about the trader bite from yesterday. If you recall, I had covered this for you yesterday. This profile and the compression, uh, the amount of compression that has occurred. This is called hypothesis histogram here, and it's likely to break. And my guess, based on the hypos, is that it would break higher. And just to continue on that thought, if you have not watched yesterday's video, it's something you want to check out. To continue on this thought, I, as a trader, have to go with what the market tells me. I have to assume that the higher probability is on the side of what is already in place. The better opportunity, and this is the paradox here that we live with as traders, is that the higher probability or the better opportunity is when I'm wrong. And I say that without tongue in cheek, because when I'm wrong, it generally brings in faster movement, more volatility, more opportunity. Does it cost me when I'm wrong? Of course it does. But that's okay as long as I don't defend or fight the market for the idea that I've already uh, that I'm trying to convey. As long as I stay loose and respond to what it's giving me, I should be able to cut that loss quickly and take advantage of the opportunity that yesterday dropped very quickly. So in review of yesterday's hypotheses, I have to assume that because we have been so close to the high and have been consolidating as I drew yesterday, that we're likely to break higher, and that was hypo 1, and the target for it is that 70 and a quarter. And so that was hypo 1. It didn't quite work out. Hypo 2 was more like it. Hypo 2 was more in line. We missed the and we did it so quickly early in the session, we missed the naked point of control that I was targeting by 3 ticks before the rotation down, and we ended up rotating all the way through. But you look at this morning, and here we are. We've bounced back up, and we're back in this exact same zone. So we'll cover the overnight session in a minute. Got to stick to the routine. But here's the push up. There's the point of control. This would give us a hypo 2 test of the point of control early. Remember, I'm looking for I'm looking for if the market doesn't pushes down, uh, it gives me a better opportunity for a long and a better opportunity for the market to push through to 22.70 and a quarter with a nice setup, and then a continuation to the naked close above that at 72. So if it pushes down, I'm looking for areas to lean against, and the key area to lean against yesterday was yesterday's the prior day's point of control. But if it pushes up, then it exhausts that little bit of energy it had from the overnight session, and then I'm looking for an area to lean against to go short back in the range. And yesterday that was hypo 2, and so here it is. It goes up, it misses the area I'm looking for by 3 ticks, rotates back down. Once it's back down in the range, I'm looking for a short. The short here is against the confluence of the open, prior day's high, and mid. Although I did not anticipate it would break through and give us a 5-point rotation right away. So what does it mean to say lean against? That's a good question. If I have a confluence of levels, these are areas. Don't look at these lines as levels that the market has to turn at. Just think of them as areas. They're zones. The market can push through by a few ticks or miss by a few ticks. It's fine. But imagine I have a confluence of things like we did up here. To lean against means to trade down, to trade short, and this becomes your backup. You're leaning against this. Think of this as a kind of a buffer or a zone that you can push against on your short and manage your risk from there. So that's what I mean by lean against. So that was the first clean opportunity for a short, and it yielded 5 points. And when it came back up, it pushed right into. Oh, my opening swings are wrong. My opening swings are up here and up here. So that the next area to, as long as it does not breach the opening swing, I'm going to look to stay short, and then I'm going to look for a continuation on this 5 point. I'm going to look for a break lower. As soon as it made this double bottom, the probability of a breakthrough is much higher. The next opportunity is right here, confluence of mid. You remember I talk about the mid a lot. The mid is the high plus the low divided by 2. Today's RTH high, the pit high plus the low divided by 2. Leaning against the mid again. This took forever. We campaigned for a little bit to try to manage the risk here, and then it finally flows through. The next target was yesterday's low. Remember, I'm a day trader. I'm not looking to swing here. And then once it rotates back into the range, then that trade is over. Okay, so yesterday ended up pushing to the downside. Much farther than expected, and it ended up returning. It ended up returning to the mid of the session, to the mid and VWAP. The session staying below the VPOC. Here's the thing that you don't see if you don't have volume profiling. You see that the market made a higher high, and a lower low, and closed somewhere in the prior day's range, on the lower end of the prior day's range. What you don't see if you don't have the volume profile is where the point of control is, or the most traded prices. The most traded price yesterday was right up against the value area the prior day. What this says is, yeah, we did drop below, but the market is not shifting value down. It is accepting, it is still stuck in balance. And so what we end up today with is the market trading right up here, right up against, it just bobbed around the 2265 overnight, and now it's stuck at 2266. We are back at the MC point of control. Remember this? Yep, we're right back here, 2265. We're right back in the point of control there. So if you look at yesterday's profile here, you'll see that we extended down. A lot of this energy got expended to the downside, and then the market comes right back and holds this balance area. This is just a head fake. The buyers are still in control, and the market's not managing to gain any territory in value to the downside. The value area shifted down, but overall the market is still standing by and waiting for a move higher. This is what it's saying. Okay, so here it is. We open and we spend uh, the great majority of the overnight session above where we closed yesterday, which means inventory is long, is completely long in price and flat in volume. Overall, the delta is pretty much at zero. There wasn't much lifting going on. The market is just shifting up with no volume to assist it. Okay, so that's where we are today. You just have to kind of take the story and what I'm going through here with you, and it may seem unimportant and too much information, but what I'm going here through with you is the story. The story gives you context. Context gives you the bias. Then you search for your entry using order flow or whatever your method is, some moving average crossover or leaning against a fib or leaning against something. And then with the context and the bias, with the bias built on good context, what you have is a strong hand in the market, meaning you're not going to get shaken out just because you got long and there a big offer comes in just above your price. That's not going to shake you out because your trade is built on something much bigger. It may still not work. It still has a 50-50 chance, regardless of what um, your statistics show for this particular trade, but it's built on something with substance. Okay, so given the overnight session here, we've got good volume in the overnight session. We've got a channel going up, and the market has essentially formed this another one of these saucer type formations, and it's looking like it wants to continue higher. The inventory is long on price, flat on volume. So I'm expecting just a choppy open in range and just outside of value from the prior day. Okay, let's see what we've done on the bigger picture. Here's the same profile from December 7th. December 7th being the day. This is the day that starts this microcomposite. Why am I starting the microcomposite this day? I'm starting it because that's the day that moved us from the last balance zone. So you can see this little dotted line. That shows you what the last composite border is. And this is the day that took us out of it. And so I start a new composite and start measuring how the market's volume at price is performing from that point onwards. Here's what we accomplished yesterday. We just pushed to these prices. So you can see here we've kind of tested this 50 area, 52, 53 area several times. We have tested the 73, the 73 area several times. We did not do anything. This is earlier we had a dip down. We had another dip that got bought up, and then yesterday we had a dip that got bought up, and every dip is higher low, a higher low, higher low. And so that's what you end up with. You end up with this triangle kind of formation in the market. It's just not moving away from the highs. It's just buyers are still in control. Okay, that's the big picture. Yesterday's volume was pretty good. It came in, the volume came in at, I think, 1.2, yeah, 1.25 million. The normal volume is 1.1, or the most common volume is 1.1. The range yesterday was 16 and a half points. The normal range, or the most common range, is 13, and it can go from 7 to 25 points in the ES for the day session. And yesterday we had 16 and a half, right in the middle. So yesterday, nothing exceptional. You want to know what it looks like? If this high kurtosis area, this high compression area breaks, you will have much higher volume. It will likely double the volume that we had yesterday, and we would likely double the range. Once this break happens, it's big. So don't get caught up with the fact that, hey, we just rotated down, and so this thing's done going to the upside. We didn't. All we did yesterday was we had a test lower. And the market recovered very, very quickly overnight. What am I expecting today? Guess what? We are right up against this. Again, we're right up against the MC point of control. I'm going to extend today's range. Watch where the volume went yesterday. Watch this profile as I extend yesterday's composite. You could see that all we did was we added a little bit of volume below, but we're back in business in the 65 area. There's nothing that has changed here. And so what does that mean for the hypos? Same old, same old. We are above the 65. We have the point of control below us. So guess what, folks? It is the same exact thing as yesterday. Open auction, look for a dip, look for an area to lean against, look for a push up, and aim for the 70 quarter again. Same hypos for the last 3 days because the market has done nothing of substance over the last 3 days. It's Groundhog Day. It's just repeats and repeats and repeats. And guess what hypo 2 is going to look like? Yes, you got it. Open auction, test up, look for the 70 quarter, look for an area to lean against, and then look for it to push back down to the 65 and potentially a little bit lower. That is your hypo 2. So I'm basically trading the same exact setups every day. Um, Makes for a pretty boring trade, but we're not here for excitement or entertainment. We're here to just respond to what the market's offering, and what the market's offering is historically compressed ranges and compressed trading. I mean, we've got so many consecutive days of a less than a 1% move. It's not even funny. Anyway, that's how things are shaping up right now. I'll leave you with that. This over the weekend, I've just been pressed. I have not been able to send out the link to the video for order flow over this weekend. Look for it. I'll put it together and send it to you, and that'll help you understand the entry part of the entry part of this process, the execution part of the process. Good luck today. Happy Friday. It is like Friday, so hit the like button on your way out. It helps me out. It helps us get whatever we need to get as YouTube develops new products and support and things like that. Good luck, and I'll catch you on Monday morning. Take care.